Good afternoon. My name is Perry Tan. I'm Head of Technical Training at the Singapore College of Insurance. It gives me great pleasure on behalf of SCI to warmly welcome all of you to this webinar on Affinity Insurance. Right, as you can see, the topic today is Affinity Insurance, and let me just briefly introduce our speaker for today. Mr. Leslie Wong is a seasoned insurance professional with over 30 years of experience in Singapore's insurance and financial services industry. Formerly a broker, and he has been involved in various roles, including motor insurance broking and customer strategies. And at a previous broking firm, he led the Affinity practice for more than 12 years and grew the portfolio significantly year on year, right? And he has driven digital transformation, membership growth, and road safety, as well as the Automobile Association of Singapore. Leslie holds a BA Insurance Management and multiple certifications. The title for today's webinar is Affinity Insurance, Growing Protection Through Partnerships. And this is the synopsis. And so today we're going to learn a little bit about Affinity Insurance and the essentials of designing an affinity proposition. Okay. But before we begin the webinar, there will be other courses by SCI you may be interested. So you can see here various courses coming up in April. We have Jeweler's Block, Commercial All Risk Wording, Marine Cargo Insurance, or of course AI, DNO coming up in April, right? And also Mastering Your Personal Cash Flow. So if you need details of all these courses, do contact us. So without much further ado, I'm going to invite Leslie to begin his presentation for today. And we just wait for the slides to come on. While the slides are coming on, the links for the courses are found in the chat box. You can access those links. Yeah, here are the slides. And now let me welcome Leslie and hand it over to you. Here's to you, Leslie.
Hi, okay. Thank you, Perry. Can everybody hear me?
Yes, we can hear you.
Okay, thank you. So yeah, very good afternoon to everyone. Today's topic, I hope you will find interesting and refreshing, because affinity insurance is actually a space where there's a lot of potential if we get things right. Yeah, so let me just get into the slides. Okay, I think we can skip this. Yeah. All right. For today, very short session, but I'll try my best to cover these four topics. So what is affinity insurance? Some core elements, critical success factors, and three examples of affinity programs. Not exactly case study, but happy to take any questions at the end of the session. Yeah, I will provision some time for Q&A. So first off, yeah, what is affinity insurance? So many people have different perspectives, and the gist of it is really summarized here. It's actually a strategic approach to build customer stickiness, and more practical one is to generate ancillary revenue. Now we know that insurance business is not the easiest thing to do, right? And through affinity solutions, we generally can create what we call a passive income, if you like, where the cash register could be ringing in the background without you having to do a lot. But the only condition is once the program is set up nicely and is running, then it's really quite easy. And the challenge is to really build up the program at the front. So the concept is really like embedding some insurance product at the point of sale as an add-on, but it is structured in a seamless way where insurance products actually plug into non-insurance platforms, products or services. Now, what are the benefits? Okay, obviously, it kind of like enhance your brand. It enhances your customer experience. It's a means to build trust, especially if the program is relevant to customers. And because of scale, right? You have uh, economies of scale, right? Because of the size of your portfolio, you can generate economies of scale versus trying to sell something one-on-one and expect the lowest price. So it's like bulk purchasing power. And from customer point of view, they are actually buying into simple products without leaving the platform, and therefore the whole process is very seamless, frictionless. At the same time, um, the insurer who has to be responsible for pricing, underwriting, and claims can actually tap into a central point to kind of like manage the program. And as the market evolves, the claim situation evolves, um, the platform can be tweaked accordingly. So here are some examples. And I think we're all familiar, right? So if I say e-commerce platforms, basically, I think you will notice that if you buy something off one of the e-commerce platforms, they do offer some form of click to purchase, or in some instances, it's actually automated where you can do like package protection. You know, if you receive your package damaged, then you get indemnity, you get some compensation. If you buy tech or digital items, these are fragile, so you can have even damage protection or risk insurance and things like that. Um, Yet there are others that will offer you like extended warranty. And in the case of not necessarily e-commerce platform, but basically membership related, HR related platforms, then you can even have group insurance coverage, things like that. So another very common one is the ride-hailing platform, where I think you will know. I mean, if I mention Grab as a name, right, you know that the drivers are protected, the passengers can be protected, and basically even things like auto insurance. So if you look at one of the larger used car, pre-owned car platforms, they also offer auto insurance, and these are all very good examples of affinity insurance. So let's talk a little bit about the attributes. Well, naturally, whatever you do, it must be relevant to that particular group's needs. Okay, and simplicity is bliss. Do not try to make uh, the product so complicated. Actually, the simpler it is, the better the take-up rate, and naturally also maybe the lower the pricing, and therefore purchase resistance will be less. But very importantly, it's got to be embedded into an existing customer journey. If you expect your customer to go out of the way to, onboard themselves into your product or your service, then it's very, very difficult. At the same time, because of today's environment, uh, the digital process, the highly automated process is actually a given. And it's not too challenging. Actually, in today's context, building front-end systems, building back-end systems, plug and play, both front and back, are not too difficult. So what Affinity Insurance really isn't is it's just not a platform for you to mass retail products and you can just anyhow sell, because obviously also there are some compliance requirements, right? MAS, our big brother, will be watching over our shoulder. And it's not a bespoke corporate insurance like some people think, oh, my company offers this and therefore I just go in and buy off my HR platform. Actually, those are not really affinity insurance. Those are really the direct purchases. And generally, while we don't say products are white label, um, it can't be just take somebody's product and you put a name to it. To qualify as an affinity insurance, there need to be partner involvement. So it's not just take a product, claim it as yours, and then you sell it. Whether you're intermediary or even your insurer, it's not as simple as that. Okay, we do have a poll question here.
Okay, you see a poll on your screen, right? So you're given a few seconds. Please just select the answer that you feel is best.
Yeah. So
Okay,
really
let's
no right.
close the poll.
Mm.
Yeah.
Yeah, no right or no wrong. Just to get a sense of what you think. Well, what you guys think. Okay, yeah. So the bulk of it kind of like the bulk of the audience kind of like understand it. So it's definitely not a bespoke corporate insurance solution as a standalone. If you do have partners involvement, I think can still qualify. And while it's generally discounted and the rates are very attractive, that just to drive engagement and drive take up rate, but it's not simply a discounted product. Okay, let's close the poll. So yes, distribution structure. There are a couple of variances. So the first one is really direct to consumer. So for this kind of a program, the insurer owns the relationship. So there are some insurers who actually offer affinity type of products directly to consumer, and that's why they own the relationship. So there's no other party other than they themselves and the client. So it's a direct distribution. Then there's the agent or broker-led version. These are the traditional intermediated distribution process where the agent or the broker will actually play an active role to bridge the link between the customer and the insurer, as well as to manage the program to drive results and basically to make the whole program sustainable. Then the last kind is the embedded or the affinity distribution type where it is partner-led. Okay, so partner-led, some companies will actually do their own control. So they kind of like look at it and manage it themselves. Of course, they will need an insurer to provide the expertise in terms of underwriting, risk, and also uh, the pricing and the claims management. So yeah, these are the typical distribution structure type. So other examples, other common examples would be the membership type, associations. So like as you might be aware, in the intro just now, I do come from association. I spent 13 years at Automobile Association. So it was there that I was kind of like first introduced to the concept of affinity. So we actually like um, availed PA programs and all kinds of micro insurance to our membership base. And it was very good in terms of engagement with the customers as well as creating that ancillary revenue. Another kind is offered by employers and HR platforms. So these are usually related to employee benefits, voluntary benefits, hospital surgical, upsell, downsell, whatever. So the employers and the HR platforms will actually offer employees with the option to either buy more, choose the product type that meets their needs, and then they can usually use some funds provided by the company. Then, of course, the financial ecosystems, payment platforms, banks, fintechs. I think this one don't really need to explain. I mean, example, credit cards, they will give you some form of insurance cover, PA or flight delay, travel, and so on and so forth, right? Lifestyle service platforms, you'll be very familiar with telcos. I think the telcos have been running this quietly for a while, and you'll be familiar. Similarly, travel platforms, when you buy travel tickets or you buy airline tickets, you also avail yourself to some of these travel insurance products. Property and housing, this is yet another space. What is trending up now is the co-living. Co-living operators now, as you might be aware, there are already a couple of listed companies offering this, and I'm sure there'll be opportunities for agents and brokers or even insurers to build something up. So it's quite a wide space now for co-living. So if you're interested, don't take too long. Hey, so why and how do these partnerships work? So basically, there are a few like components. First is, of course, it needs to be defined and homogeneous, in terms of the customer segment. If you have two diversified customer segment, so for example, you're selling to a very large membership base, but then the membership may have life members, they may have associate members, and then they may have ordinary members, they may have family members. So if there are too many types of customer segments, then in terms of your product, it may not be so homogeneous and not so clearly defined. Then it's difficult because each of these segments will be pulling their own weight. The other one is, of course, as in all insurance business, there must be trust and as well as frequent engagement, right? Before these kind of like partnerships are sustainable. This frequent engagement is really amongst all the stakeholders, not just the customer and the platform or the customer and the service provider. So, in terms of why these partnerships work also is because very often, I mean, live events, usage, there will be some form of natural insurance triggers that will actually bring to the front the need for protection or indemnity. So some of these will work because there will be insurance requirements. And then there must be open communications, and this ties in quite with the trust and the engagement. So, in short, okay, the best affinity partners are not necessarily those with the largest database. I mean, to have large database is nice, but um, it not necessarily that you have a large database, you win. Okay, rather those with the clearest relationship and influence over their customers, where the stakeholder can influence customer, to engage and to consider picking up the affinity solution, then you will get traction. Okay, so this is a busy slide, a rather noisy slide. So I will just spend a little bit more time on this slide. So clear customer value proposition. So you have to consider things like what problem is being solved. Okay. So for example, if I use the private hire car example, all right. So one of the big challenges is passengers get injured in accident, right? in a motor accident. So on its own, if the customer has got no personal accident of their own, then there may be some complication. So if let's say you are the private hire company and you're providing this ride-hailing service, then you have a clearer customer value proposition by saying if you ride in my uh, vehicle, besides good drivers, besides clean cars, at the end of the day, the worst situation, if there's an accident and you are injured, there's medical insurance cover, there's some monetary compensation, and so on and so forth. So this is one aspect. Then the other one is, why is this relevant now? Obviously, this is relevant because of the risk exposure, and that risk exposure is real. If you look at data of accidents, right, a high proportion is also within this segment because private drivers, not necessarily they are better drivers or they're more careful, but if you are a taxi driver or you're a private hire driver, you will probably understand driving fatigue, the rush to try and clock another two journeys so they can take more money home. So there will be some form of shortcuts, risk taking and so on. But the main thing is nobody wants to be in an accident, but if it happens, there is some protection. Yeah. And then, of course, the next one is to ask yourself, why through this partner? So is it this broker if you are the stakeholder, right? If you are the sponsor, is this broker experienced? Is this agent knowledgeable enough, friendly enough? Or is this insurer the right partner? So you need to have all this set up to have, kind of like the definition of a good affinity proposition. Okay, next, I think product simplicity is a little bit easier. So don't give like 7 option A to Z, rather A to H or A to J, have limited coverage options, A or B, then have any exclusions clearly stated and indicated. Then of course, don't try to make underwriting a big thing. It's really just click to buy. Don't make them declare your medical history and whatever. So minimal underwriting friction, ballpark, auto approve. That's it. And of course the easy onboarding process. Last but not least, I think claims process is very often an afterthought. So in good affinity programs, I've seen programs that says, okay, you file a claim, you get paid like almost instantly. So that process of automating that claims assessment and all that is frictionless from the customer point of view, and people will love you if you are able to achieve that. Okay, unlike in the old days, right? You submit a H&S claim to the company, right? You might have to wait 2 weeks, 3 weeks, sometimes months. Even then now, you see in the market, right? A lot of insurers now promise you within 3 working days, within 5 working days. One very brave insurer even say within 24 hours. So things like that, in terms of affinity proposition, if you can design and engineer your product to have all these core elements as a main thought and not an afterthought, then you're on very good ground. Then next, pricing logic. Obviously, uh, because of our competitive society, right? Your pricing logic must make sense. I mean, that's a given. There must be some form of transparency. I think for affinity program, most people will have this thinking that, okay, maybe the insurer benefits the most because they make the best money, or maybe even the broker makes the best money. So what's in it for me? Okay. But at the same time, if you go too lean, right? Too lean, then whether your loss ratios are sustainable or not. So this is challenging. Okay, there's no right or no wrong. So a lot of times at the front of the product build, right? the insurer usually takes a leap of faith and then adjusts as it goes along. But at the end of the day, the pricing logic must make sense for all parties. Okay, so this next point, the seamless customer experience. Of course, I mentioned this just now. From the customer perspective, it's just one click, I'm in. I just say yes, I'm in, and then I have all the information at my fingertips. So everything is all system pushed, documentation, uh, evidence of cover, even receipts of payment and things like that, so that the customer experience is as seamless as possible, then it makes sense. So the tip below there just very simply reads as, if whatever you're trying to offer needs explanation, right, then it's probably not Affinity ready. So it needs to be very clear, one page, few bullet points, everything is there, that's it. Okay, so that's the core elements of a good Affinity proposition. So, okay, another very busy slide. So now I'm introducing the stakeholders and sponsor. So when we talk about Affinity solution, it's usually involving a clearly defined group where you have stakeholders and you have sponsor. So who is the stakeholder? Stakeholders, you know, influence the program. Stakeholders will be affected by outcomes. It execute or support parts of the program, but do not own the program. So based on this, what do you think? Is this the broker, the agent? Can this be the insurer? Okay, I leave that to you to decipher. But basically, when I talk about the stakeholder responsibilities, right, they have to execute agreed tasks, they provide data and operational input, they flag risks or constraints early, they support customer communication and servicing. So this one really looks more like the intermediary, isn't it, as a stakeholder, right? So sponsor, who is the sponsor? So the sponsor owns the program in a strategic way. They must have authority to approve, fund, continue, or terminate. Okay, so it's accountable for program success. So who do you think this is? Insurer, the client, the end client itself that's trying to build this Affinity solution. Again, I leave it to you to decipher for yourself, but basically think of the sponsor as the program owner, okay, who has a vested interest in it. And therefore, it approves the business case, it agrees on the success metrics, right? It even needs to resolve escalations. It commits resources, right? Whether it's budget, whether it's people, whether it's systems, and owns the reputation and customer outcome. So up to this point, I guess it's very clear who stakeholders are and who sponsors are. Okay, so let's talk a little bit about the underwriting and the data considerations. So obviously, it it ultimately is still an insurance product. So you need to have risk selection, because if you have anti-selection for a start, right, then this program is likely to be unsustainable. So in terms of affinity, right, it's very different from individual insured. So individual insured, you can do underwriting, right? But for affinity programs, generally, we are talking about portfolio underwriting. So for example, if we are doing a loan protection, right? In a traditional way, if it's an individual, the bank will look at wow, your financials, right? What's your job? How much wealth you have and all that before they decide whether they want to grant you a loan or not. But for group and for affinity program, it has to be portfolio, and therefore, if I'm using the same example as a loan portfolio, then I'll just need to underwrite based on the country's national data, in terms of economic growth, in terms of financial strength, and so on and so forth. So portfolio underwriting is the key versus individual. And if you are targeting a specific group, you must understand why this group is different. Okay. And that's where the risk selection is very clear. So I give a very simple example. If you are if you are trying to do a PA, a group PA, you on one hand you say, okay, maybe the elderly may be more prone to accidents, right? But at the same time, another end of the spectrum, maybe the younger ones, the children, the teenagers, and the very young adults, they may be more adventurous and therefore they may be also equally accident prone. So when you're writing group PA for a select group of people, you must really deep dive into why this group is different and what makes the differentiation. Okay. So um basically, if you are not being able to avoid adverse selection, then it is just disguised as affinity and likely doomed to fail. Okay, because once the loss ratios catch up, um, insurer feels the heat, then either the premium rates go sky high, or the insurer will just say, okay, it's time to pull out and stop the program. So data that matters, obviously, the larger the size of the group, the more stable um, the characteristics, the performance. Um, Directly related is also the demographics and the behavior. So if you're insuring, you know, uh, let's say commercial drivers versus you're insuring private car owners, the behavior can be very different, right? So also in terms of planning the portfolio size, you need to do some projections on take-up expectation. So um, we use, or rather in my previous experience, I used to have this challenge. So what is the take-up? Okay. And the problem is you don't know, right? At that time, you don't know. So the only way you can do is try to research whether somewhere else in the world there's a similar program, or somewhere else in Singapore somebody has tried it, and therefore you make certain assumptions, and then you need to buffer in some facts, so to speak, to make your program workable. Of course, if you have historical loss indicators, that's great. But even if you don't have, I think it's quite safe to make some uh, projections based on national data. I think that's quite safe. Okay, some common underwriting pitfalls. Uh, Embarrassingly, yes, I think everybody who tries to build affinity programs may come across this kind of situation. So some of the common pitfalls, we over rely on partner optimism. Okay, so your partner will come to you, oh, don't worry, I got 20,000 drivers, right? And we are running 2 million trips, every week. So, if I were to give you the 0.1% take-up rate times the 2 million trip, then you calculate the premium. It looks fantastic. But then if you over rely on that partner optimism, then chances are it's not going to be very sustainable. Then, of course, the other one is when you when you're forced to go in blind, when you got no means to validate data, when you don't have enough information, but yet you want to do this program, then I would suggest that you can start off cautiously and then tweak as the program progresses. Then another one is the marketing people will always tell you that uh, you need to price competitively. So this pricing, if it's driven by marketing and it's not driven by the cost of risk, then it's dangerous. Last but not least, of course, underestimating claims and servicing costs. Now, typically, affinity programs, I don't see like catastrophic losses unless you are like insuring everybody on an airplane and the same airplane goes down, right? So typically, you don't see major losses, but you do see some higher frequency, but lower severity. So in terms of the claims cost, in terms of the servicing cost, and really the servicing cost, a lot of it is underestimated because you don't see it up front. You realize that, oh, suddenly your process involves doing this step one, step two, step three, and then each of these steps actually costs you money, right? Then your claims cost will go up, not necessarily your claims losses, but your claims costs will go up. Yeah, so these are a couple of underwriting and data considerations that we need to consider carefully. Okay, let's do this next poll. Okay, give yourself a quick look, and again, there's really no right or wrong. Wow, okay. Low take-up rate, yes. Poor underwriting data, naturally. Okay, regulatory and compliance issue, sometimes, yes. I didn't really cover that, but it will pop up in a little while. Of course, yes, operational complexity. Sometimes the program fails because it's too expensive to get people to really manage the complexity of the claim, the servicing, and all that. Yep. Okay, yeah. I mentioned that I didn't really cover the compliance part. Here it is. So some of the key things you need to really think about is whether this program is compliant or not. Because as you're aware, right, our insurance environment, right, MES has very stringent requirements for sales and distribution of insurance products. So who sells, who distributes, who collects money, who assesses claims, who pays out the claims, and what happens if there's a complaint, So there's quite a lot of complexity in it, but there are ways and means to streamline all this. And really, I think down the road, we may decide to run a course on Affinity. SCI may decide to do that. And if you're interested, look out for it and sign up, because then I will go deep dive into quite a bit of all these aspects, right? So yeah, so the due diligence need to be done, preferably by legally qualified people, either legal counsel, compliance department, to understand provisions of the local legislation, example, Insurance Act, right? So these are things that you need to review thoroughly, the due diligence part. So the question is there insurable interest, right? So very straightforward example is like, okay, I'm a property agent. I have this um, home insurance uh, solution, right? But, you know, the person who's looking at this is just, you know, another agent or this is a tenant, right? So wanting to buy contents cover uh, for property that doesn't belong to him, right? So is there insurable interest? So you need to look at simple things like this, right? So I mentioned just now who is selling, who is distributing. Both are equally important. And then who can collect premium, who cannot collect premium, right? So these are all requirements within the Act. Uh, Premium payment warranty, not so big of a challenge. I mean, for individual covers, it's cash before cover. Even if this is not individual, then yeah, you have your 60 days or whatever for GI products, right? But for individual products, individual personal lines is definitely cash before cover, things like that. How do you manage that? Um, the money flow process. The money flow is not just between the insured and the stakeholder, the sponsor, right? It also goes around even if this is a program that crosses territorial borders, then you really need to also think through the money flow process. Um, some countries, there are a lot of restrictions as to money flowing in and out of the country. So one example is China. China is very strict on this. And actually, all countries are pretty strict. It's just like Singapore. MAS is not very happy if your premium flows out to an insurer outside Singapore, right? Whereas, uh, you know, there's an insurer in the market who can do this. So the question is always asked, why are you pushing revenue flow outward, right? So things like that. So you need to consider all that. Claims filing and handling. So insurers are also bound by some restriction, as in, um, can they outsource claims handling and things like that? So last but not least, claim processing and payment. Who makes the decision to pay or not? Who makes the decision how much to pay? And who actually makes the payment? So these are all compliance issues around a typical affinity insurance solution. Next slide, please. Okay, so this slide sums up the whole ecosystem. So I won't cover it. I believe you'll be given a copy of this slide. So generally, this is just the entire ecosystem. Generally, all this must be there and must be pretty neatly connected for your program to work. Okay, next slide, please. Okay, so because I realize that I'm going to be running out of time, so I'm just trying to finish up to allow more time for Q&A. So in terms of why affinity insurance solutions matters, especially now. Okay, in our climate, right? So everything is challenging, cost is rising, consumers, the insurers are all very cautious. So in terms of the acquisition cost for um, people who want to buy into such programs, right? Then generally you need to think about it. So affinity is one very economical machinery if you set it up correctly. And then simplicity is bliss. A lot of consumers nowadays, they just want bite size. They don't want to think about it. If this thing is only going to cost me 10 cents a ride or 30 cents a ride or $1 a month for whatever coverage I'm going to get, I'll just click and buy and I won't think about it. So there is rising demand for simpler bite-sized products. And also it supports the new normal because now we're talking about digital era. We're talking about people using AI to ask, is this product relevant? How is it relevant to me? Why should I buy? Why should I not buy? Things like that. And the current uh, embedded commerce and e-commerce environment, everything is now moving away, right, from brick and mortar to digital environment. So Affinity Insurance Solution is a perfect fit because there is tremendous revenue potential. Okay. And last but not least, there's a growing desire for value-added services, not just products. So if you can bundle, a product with some value-added service, why not? So one example I can tell you is like cyber insurance, even personal cyber insurance. Uh, a lot of people are not so concerned about, okay lah, I'm going to be covered for $10,000 if my data gets hacked and so on, right? But they want the value-added services that, in a time of need, there's somebody to hold my hand, there's somebody to like save me, so to speak, right? So I think this is why Affinity Insurance Solutions is important. Okay, so critical success factor, sustainable affinity insurance. Okay, I think these are all pretty straightforward. I'm just going to skip a little bit. The commercial sustainability is quite self-explanatory, and the operational sustainability as well. Basically automation where possible so that you don't have to like spend a lot of time maintaining it. Okay, next slide. Okay, customer sustainability, governance and review. Um, I think the one that I want to quite mention is that um, it has to be an ongoing partnership ecosystem, right? So whether it's governance, whether it's customer, it has to be kind of like all linked. Okay, very quickly this poll. So this one is also a bit of a perspective. Do you think financial ecosystem, you think lifestyle, or you think HR, or you think retail, which is the sector you think that has got the strongest opportunity? Wow, okay. Quite balanced. I agree that employers and HR platforms seem to be like lagging, but if you talk to, let's say, the HR practitioners circle, there is actually quite a pent-up demand because affinity solutions can actually help HR solve their problem in terms of the employee benefits, the employee welfare. Yep. Okay, let's move on. I think I'm at the last end already where the next one will be some case study. Yes. So just three more slides. Telco, I think we know, right? We used to have all risk insurance. We still have extended warranty. The telco still try to sell you travel insurance as well as home content insurance. I don't need to mention any names. I think you know which telco does this in a big way. Okay, next. HR platform, like I said, this is not so prevalent, but there are a number of rather huge companies, usually the MNCs, with like thousands of employees, then this becomes very useful for them. Major retailer, again, in terms of extended warranty for appliances, all risk protection for items, payment protection, extended warranty. I think these are all very, very common. Now, naturally, earlier I talked about the fact that like all these private hire companies, mobility service providers, uh, ride hailing and all that, they all also have their own versions lah. So yeah. So I kind of like come to the end of my presentation. So very happy to take questions. And this is where I think I need help because I can't see the questions. Yeah.
No problem. Thank you,
Mm.
Leslie. We have one question coming in from Ding. Um, it says that on the APAC-wide scale, do you have statistics on the profitability of affinity insurance when insurers are normally subject to very high payout ratio to platformers?
Okay, so obviously, in terms of uh, performance of a particular program, um, it's not necessarily that there must be very high payout ratios. It's really what you're insuring and what is your risk cost. So usually insurers will be able to do the estimation based on their own available data. And even if they don't, they have actuaries who can do certain projections. So for this, in terms of the financial number, we really need the people who are experts. It's not you and I who just think that, okay, fire risk building, okay, 0.02%, and that's it, we are done, So it all depends on what you're insuring, what's your total risk exposure versus, and I mentioned this, right? What is your take-up rate? Because you got a nice program, you only got 100 clients inside your program, and you got 10 claims that you can be wiped out, right?
Okay, all right. Thank you, Leslie. I've got another question here for you. Let's see, how do we differentiate between genuine affinity risk pooling and adverse selection disguised as an affinity group?
Mm, okay. Yeah, that's a very good question. Um, you you need to consider what is the motivation for the stakeholder, right, or the sponsor to want to have this program, right? And honestly, I've come across, okay, maybe now it's not so secret anymore. I can just come across, give you example without mentioning names. In the past, there were people who were very hung up on giving, the bicycle rental by the hour, by the minute, by the journey, and that stakeholder wanted a program such that they want their equipment covered, they want the customer covered, and then they want a big cut of the premium. Okay, so it's not so simple, right? I mean, if I could do that, then the broker also be very rich and loaded already. But the reality is the expectation must be real, and therefore, if we miss that part and we think that okay, this is great, wow, great opportunity, then you can set up the program. So actually, that's one example where it's disguised as their own interest really more than the real customer interest, lah. Put it that way.
Okay,
Right.
all right, thank you. All right, I have another question here. Okay, um, basically, yeah, right. If we talk about revenue and sustainability, I've often wondered how would revenue sharing be structured to ensure long-term sustainability without distorting underwriting discipline?
Again, a very good question. And we always have this challenge because insurers are also bound by the fact that, okay, it'll be a bit absurd if you say, okay, for $1 of premium, and then the insurer can give you 70 cents of commission, right? And then you go and share with whoever, whatever, right? So it's a little bit absurd, and I don't think that makes sense. Of course, usually the stakeholders are not so driven or about wanting revenue from the sales of the program. They rather want more customer interaction. They want more customer loyalty. And where customers see value that by doing this through uh, the platform of that company, right, it makes sense. So in terms of revenue sharing, actually MAS does not really impose, strict guidelines. It just needs to be reasonable. I think that word is very subjective. What is reasonable? Is it 30% of my commission as the broker to give it to someone else? And I give half of it. Is it reasonable? So far, typically, brokers take very low commission to make the program sustainable, but brokers are kind of like uh, enjoying the revenue through scale and volume, not so much of just the quantum of one case. Hope I answered that question.
Okay, thank you. I think we have time for just one more question, Leslie, right? Let's see, you're obviously very experienced in this area. What are the most common pitfalls you have seen in affinity programs?
Oh, pitfalls. Oh, yes. Um, I think I also mentioned that in the slides. One of the pitfall is really you got all your data and all your structure wrong. Okay, so you think that it's going to work, and then when you launch it, then you find that okay. So for example, your take-up rate is way below, and you thought that your take-up rate would be good because your program is so attractive. But then at the end of the day, maybe the pricing is not. So in my slides, if you were to refer to it, then there really a the critical success factors that I mentioned there that you need to look at and basically of course there's no like really right or wrong, but essentially if you get the gist of the things right, you can slowly tweak along the way. Um, I don't know whether what I've just said makes sense, but generally the pitfalls would be like underwriting and pricing. You need to get that right. You need to have your claims processes right. You need to have your even MAS licensing, all those obligations. You need to have all that right. Then I guess it's a good start point. The rest, like I say, if you have over projected take up rate or your price has gone too high or too low, it can be adjusted along the way. And that's where also you need the support of both the insurer as well as the sponsor to be in it together as a partner, not one partner win, the other doesn't win, then it's not sustainable. Yeah.
Okay, thank you, Leslie. It's very time. Let's see. I think we have one more question. Okay, all right. Oh, very good. Okay, one more question in the Q&A chat box. Do we have any data regarding a bad affinity insurance experience from one country, but does not work the same way with another country or region, especially in Asia? Kindly give out an example and reason for this.
Okay. Yeah. So again, I mean, from where I came from, it's a very large international broker. So obviously I cannot put the name out. So we had, um, as a very simple example, we had motor insurance programs running across different countries for the same manufacturer or the same car dealer. Okay, but because uh, behavior is different, claim cost is different, but the client wanted to have a single kind of like point of rating, a kind of like one size fit all kind of thing. And along the way, some countries worked, some countries didn't. So, so in terms of um, that perspective, right, I don't think it's doable to have one size fit all. You need to really drill down into very deep local statistics to determine what the specification going to look like for that particular country. Yeah.
Okay, all right. Thank you so much, Leslie. Ladies and gentlemen, we have come to the end of this afternoon session, but I trust you have learned so much about affinity insurance, and it's very possible that SCI intends to run perhaps a longer version, a more in-depth course on affinity insurance. So stay tuned and listen for any news on this. We will let you know definitely. Leslie, on behalf of SCI, thank you so much for sharing your expertise and insights on this topic of affinity insurance. Right now, before we end this session, there will be an evaluation on your screen. As you close this session, you'll see an evaluation on your screen. Your feedback is very important to us, so please help us fill in this evaluation. And on behalf of SCI, I wish you a good evening ahead. Bye bye.
Yes. Thank you, everyone.
Thank you.